I'm Jesse Mackey, CIO of 4Thought Financial Group. This is 4Thought's weekly market perspective for the week of July 14th, 2020. During the last week, stocks have experienced continued intraday volatility, but with little net movement to the upside or downside by the end of the week. This relative flattening represents a moderation of the aggressive move upward that followed the dive into a bear market during late February and most of March. The most recent low point for the S&P 500 index of U.S. large-cap stocks was on March 23rd, which pointed to drop more than 34% from the record peak achieved on February 19th. After the partial recovery since then, it sat 7.02% below its record peak as of the close of business yesterday on July 13th. Historical market type statistical analysis reveals that once a bear market is confirmed, which occurred on March 11th, the average time to the trough of the cycle is approximately 5 to 6 months later. The average additional loss is approximately 16.72% from the bear confirmation point. Although both the actual time to the trough and the additional cumulative loss can vary widely depending on the specific time period referenced. For long-term investors, this window has historically proven a very opportune time to deploy any excess cash accumulated in bank checking and savings accounts that's not needed for short-term expenses or savings goals, or to supplement household living expenses in the event of a temporary loss of earned income. Given the already elapsed time since confirmation of the most recent bear market, any cash deployment should take the form of an immediate initial lump sum injection of 90% of the investable cash, with the remaining 10% deployed by the middle of August. Long-term investors should speak to their advisors regarding whether and how to implement this, based on their particular financial situation. From a probabilistic analysis perspective, stock types range from slightly undervalued, such as with mid-cap stocks, to moderately overvalued, in the case of large-cap growth stocks. Bond types also range from slightly undervalued, in the case of emerging markets bonds, to moderately overvalued, in the case of long-term U.S. Treasury bonds. Against this backdrop, the outlook for stocks is now positive in the intermediate term based on the overall aggregate of our historical market type data analysis and quantitative probabilistic analysis. U.S. aggregate bonds and Treasury inflation-protected securities are the best performers so far in 2020, while U.S. small-cap stocks show the worst year-to-date performance. U.S. mid-cap stocks now reflect the most attractive pricing relative to the alternatives, while long-term U.S. Treasury bonds are the least attractive. With regards to allocations amongst investment methods, now allowing overweight allocations to strategic asset allocation, neutral allocations to liability-driven investing, and underweights to selective concentrated investing and opportunistic investing. I hope this was helpful. If you have questions or you'd like to discuss how to implement any of this, please contact 4Thought at 516-300-1617 or at info@4tfg.com. And don't forget to subscribe to our blog feed and to our YouTube channel. Thanks for watching, and see you next week.